Did you know that, since its inception, Bitcoin has been the best-performing asset class worldwide? In fact, at its current $1.87 trillion valuation, Bitcoin has even surpassed Alphabet, formerly Google, to become the world's fifth-largest asset, only behind NVIDIA, NVDA, Microsoft, MSFT, Apple, AAPL, and gold. However, the recent market tariff turmoil resulted in a risk-off environment and a 30% pullback from the all-time high of $109,000 achieved last year. One of the long-term bearish arguments against Bitcoin is that it is just another risk-on asset. Historically, you may have observed that Bitcoin has acted like a leveraged NASDAQ product, dramatically outperforming in equity bull markets and underperforming in bear markets. However, this week, Bitcoin and the iShares Bitcoin ETF, IBIT, went a long way in disproving that. Despite the carnage in equities early in the week, Bitcoin rose 3%, regaining its 50-day moving average. The relative strength in the world's largest cryptocurrency stood out like a sore thumb Monday. But it's not just a one-day occurrence. It is becoming a trend. While the NASDAQ and the major U.S. equity indexes are stuck below their long-term 200-day moving averages, Bitcoin is above its midterm 50-day moving average. Meanwhile, Bitcoin is nearly flat, while the S&P 500 Index ETF, SPY, and NASDAQ 100 Index ETF, QQQ, are each down double digits. Bitcoin is a safe haven against tariffs and fiat mayhem. With China and the United States currently stuck in the middle of a nasty and escalating trade war, there is a plethora of macroeconomic uncertainty. Unlike fiat currency, Bitcoin has unique and powerful attributes, including scarcity, decentralization, and global accessibility. As trade wars press on, international investors will likely park some of their funds in Bitcoin, leveraging the unique asset as an escape hatch. Liquidity is king. In over 2 decades of investing experience, I have learned that liquidity is king on Wall Street. But don't just take it from me, take it from legendary billionaire investor Stanley Druckenmiller. Druckenmiller teaches that earnings don't move the overall market, it's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. Most people in the market are looking for earnings and conventional measures. It's liquidity that moves markets. Fed Chair Jerome Powell recently portrayed a hawkish tone, signaling that he was not ready to cut interest rates and was concerned about the potential for tariff-induced inflation. But I always teach that it's important that investors like you should pay attention to what the Fed is likely to do, instead of blindly listening to its rhetoric. In other words, you should rely on what the market is pricing in, because after all, it represents real-time, real money odds. The Chicago Mercantile Exchange, CME FedWatch tool, an indicator that tracks the latest odds of a FOMC rate move, suggests that multiple interest rate cuts will occur in 2025, a bullish sign for assets like Bitcoin. Bitcoin is correlated to the money supply. However, it's not enough to focus only on U.S. liquidity. Remember, Bitcoin is an international asset. Thus, we must focus on global liquidity. Global M2 measures the world's money supply, or the different forms of liquid assets that can be quickly turned to cash. Bitcoin exhibits a shockingly high correlation when compared to M2, with a 60 to 90-day lag. With central banks primed to print money and global M2 set to soar, Bitcoin should follow suit. Bitcoin's bullish seasonality period. Historical seasonality patterns have been extremely accurate for Bitcoin in recent years. The seasonality roadmap suggests that Bitcoin should rally into August before retreating.